Hello, everybody, and welcome back. Today, my guest is Ben Ritchie from Aberdeen Standard Investments. Ben is the head of European Equity. Welcome, Ben.
Thank you very much for having me.
Ben, European capital markets and European stocks have been hit hard by COVID-19, and we have seen this crazy development since beginning of the year. So, can you describe the situation from your point of view as a portfolio manager?
Well, it's certainly been a very volatile year. We saw the first quarter really marked by the decline in equity markets, panic effectively as COVID-19 set in across Europe and increasingly across the United States. And we saw equity markets fall something like 35% across Europe. We saw bond yields collapse. We saw the oil price turn negative over that period. So there was a huge amount of volatility, a lot of uncertainty. Since that period, as the virus has been brought under control across Europe, as we've seen the deployment of fiscal response and monetary policy response, we've gradually seen a recovery staged across equity markets. And now we've come back within 10% or so of where we had reached in February prior to the crisis. And I think we've reached an interesting point for investors because we've started to price in, I think, an awful lot of recovery. And I think it's now the question of whether or not that can actually be delivered. And I think it's going to be very interesting as we move through the remainder of 2020 and into 2021, exactly how that plays out, both at the economic level and most importantly, at the company level.
Yeah, I think this is the most important question for European investors. So, what is currently the case for European stocks, and why should I invest in the current market stage?
Well, I think one of the things that's come out of this crisis, as quite often is the case, is opportunities. Not necessarily to buy companies at incredibly cheap prices, but I think that to some extent this has been a validation of a number of important elements within Europe. First of all, I think European companies have handled themselves generally pretty well during this crisis. They've responded, they've reacted, and they've managed their way through this crisis. So the level of dilution from equity issuance or so forth has been pretty low, and I think that's been very encouraging. The other side to it, then, I think the political and monetary policy response has also been coordinated and I think exceeded people's expectations. So that unifying effect of Europe supporting the markets and the economy, again, I think is very important in contrast to what happened in the Eurozone crisis. The other thing that I think this, again, has brought everyone's attention to is the environmental, social, and governance aspects. And again, I think Europe is a leader in this area, and that's going to be critical in terms of driving flows into the market and also allowing European companies to avoid risks and take advantage of opportunities. And all of those things, I think, form an attractive backdrop for European companies to take advantage of their traditional strengths: great IP, world-class brands, good science and technology backing, elements of digital technology leadership, all of these things which we think can really drive good returns. So I think the investment backdrop has really improved for Europe. We've proved ourselves to some degree in this crisis, and that, I think, may well allow investors to come back to this market and really appreciate company fundamentals.
So on the one hand, we have seen this steep recovery of stock prices since March. On the other hand, we get a lot of earning warnings currently, and I'm pretty sure we'll get much more in the near future. So how does this fit together? And what is your opinion when it comes to current valuation levels of European stocks?
I think European stocks still look quite attractive in the context of the world of interest rates which we live in. So we live in a world of negative German bonds, very low bond yields across most of the developed world. And in that environment, you can still buy very high quality equity franchises with a 4% free cash flow yield, where we would hope to see that cash grow at high single digit, maybe even double digits over the long term, implying total returns, well in excess of double digits. Those opportunities are still out there for European equity investors, and when we compare that to credit, we think that looks pretty compelling. Overall, when we look at the dynamics in the marketplace, I think we do face a degree of uncertainty in the short term. We've seen this big recovery. I think investors have given companies the benefit of the doubt during the second quarter reporting period. Expectations were very low. Companies have generally exceeded that. I suspect that we will continue to see positive data revisions through the third quarter, and that's really a function of numbers. I think the big question is what happens as we move through into Q4 and into early 2021. Can the recovery sustain itself, or does it need more extension of fiscal and monetary support to keep it going? And I think that's the bit where we just don't know at this stage.
It's often said that in Europe we are lacking these big technology companies like Amazon, Alphabet, Facebook, or Apple in the US, or Alibaba and Tencent in China. To what degree is this a disadvantage for us in Europe? And are we lacking innovation power?
Well, it's a great question. Certainly, it's one of the reasons why the European market has underperformed the US by such a big degree over the last decade. It's not the only reason, but one of the reasons has been a lack of that earnings power, which we've seen coming through from the technology and science and innovation sectors in the United States. I think it's natural, though, within Europe, where you've got within our market, we have 20 different countries in the index. Those individual country markets are smaller. Typically, US companies tend to enjoy that larger home market. It creates a bigger platform environment, and that's what we've seen. And those companies have also gone global. But within Europe, we've got many local winners as well, and we have many niche companies that are also excellent in the fields that they operate in. And I think for an investor who's prepared to sort of ignore the benchmark, which probably only puts a 6 or 7% weighting on technology, but is prepared to invest more broadly into the swathe of companies that are out there, then actually we see plenty of opportunities to benefit from companies in payments, such as Adyen, payments in software, companies in software such as Nemechek or SAP, companies within the infrastructure space, such as ASML. I mean, Europe really does have some leading companies. You just have to look for them and be prepared to bet against the benchmark to some degree.
You mentioned Nemechek. What exactly are they doing, and why particular do you like this stock?
Nemechek is a company that was, I think, founded about 40 years ago by Professor Nemechek. It's a company that specializes, originally anyway, in software to help the design process for architects, and has developed its business through a series of acquisitions over a number of years to expand its suite of products within the design and build segments. And it's actually been able to create really leading positions, particularly in Germany, particularly in Europe, and then expanded that technology capability on a global basis. It's a business which makes very high margins. The end markets it operates in are growing nicely as we see the penetration of increasing software and design within those architectural marketplaces, particularly driven by regulation. There's opportunities to grow in fast-growing markets such as China and other emerging markets. It's a lot of recurring revenue from its sort of installed base of customers, and it's that combination of high growth, good margins, and recurring income that means that we really like this company. And the market cap is relatively small. We see a long runway for growth for Nemechek over the long term.
To what extent did you align your portfolios since the beginning of the year and the outbreak of COVID-19? Have you made any fundamental changes to European stock portfolios?
No, I think is probably the short answer. We have a very clear approach. We want to focus in on the best companies we can find in a European context at valuations which imply attractive long-term returns to us as investors. And we run, typically speaking, concentrated portfolios, perhaps around 30 stocks in those portfolios, focusing in on those high-quality businesses. That's a strategy that served us particularly well during the very tricky first 3 or 4 months of the year. And we've been able to keep up so far, more or less, with the recovery in markets since the trough at the end of March. So we've taken the opportunity to invest in a couple of companies which have been oversold. So we bought a stake in MTU Aero Engines, a German company that manufactures component parts for some of the world's largest jet engine programs. As you can imagine, that's been a pretty tough place to be in recent times, but it's a great company. Long term, we think it's got very good prospects, and we saw a good opportunity to buy it at what we thought was quite a distressed price. And at the same time, we've been able to take advantage of our research base, identifying interesting companies like Adyen, which is a Dutch company, but a leader in digital online payments, again, effectively facilitating this sort of online economy and allowing us to participate in that. And then again, a company like Schibsted, a Norwegian listed company, but again, participating primarily through the classifieds, online classified space. It's just participated in the purchase of eBay's European assets. Again, a good example of a niche European company, but able to participate in these attractive longer-term growth opportunities. So those are some of the things we've been up to. We've also been able to take advantage of some of the opportunities that have been thrown up as well over this period.
In no other market, ESG plays that important role for investing as in Europe. So to what extent is this an advantage for the European capital market? How can companies in Europe, but of course also investors, benefit from this deep knowledge when it comes to ESG?
I think there's sort of two sides to it, really. I think there's how will the European capital markets develop, and then I think the other piece around what is happening at the company level. I think Europe's really well positioned to benefit from it, investors wanting to put money into companies that act in a responsible fashion, whether it's socially responsible, whether they govern themselves in the right kind of ways, whether they're participating in environmental practices that are helping us solve some of the major challenges which we face. I can only see that that's going to increase from here, and European companies score very well on a global basis in that area. So I think for the European capital markets, I think that's a big positive, and it's something we're going to see coming through over years to come. From a company-specific level, we see risks and opportunities. And as an investor in the marketplace, and we have ESG analysis fully integrated into our approach, it gives us a really good position to be able to try and avoid some of the risks that are posed, as well as take advantage of some of the opportunities. I mean, one example of a risk might be a company like Wirecard, for example. So, the lack of focus on governance was something which we'd identified, didn't own in this strategy, and therefore we're able to avoid something ultimately that turned into an issue. On the other hand of that, there are going to be plenty of opportunities that come through from companies which can benefit from that investment behind environmental and social aspects. And again, that's going to be an area where if we can identify those things early on, the potential to benefit over the longer term is very much there. An example of a business in that space for us that we're looking at might be something like Nordbremse, again, a leader in terms of manufacturer of braking systems for trains and trucks, but particularly for trains. That's an area which we expect to benefit from significant investment as people move away from flying and move towards more localized systems of transport. They're in an incredibly strong position in this marketplace. And that's the kind of business that can benefit from some of these powerful environmental trends over the longer term. So I think it's very much about avoiding risks, taking advantage of opportunities, but overall, I think Europe's in a great place when it comes to benefiting from the focus on ESG.
This was Ben Ritchie from Aberdeen Standard Investments. Thank you very much, Ben, for being with us today and sharing your views.
Thank you very much for having me. It was a pleasure.